Welcome to Nasdaq Trade Talks. ESG investing has been on the minds of a lot of investors, but there are still concerns about the viability and risk in the space. Now, insurance firms are investing in the market in line with efforts to combat climate change and limit risk exposure. Here to discuss ESG investments and how insurers are navigating the market is Scott Kurland, Managing Director with SS&C Insurance Solutions. Scott, it's great to see you. Welcome to Trade Talks.
Thanks, Jill. Happy to join you guys today.
What are the key trends for insurers as it relates to ESG investing?
Great question. Well, we are seeing across the insurance market today that with the persistent low yield environment and increasing focus among boards and constituents in ESG investing, that insurers are getting more and more involved in both public and private ESG investment vehicles for a few reasons. One, to address environmental, social, and governance general market pressures, and secondly, to find ways to diversify their investment portfolio and in many cases increase yield. I think there was a recent study that by Bloomberg Intelligence that anticipates ESG investments and assets rising to something north of $50 trillion by 2025. So it's a big focused area. And we're seeing really two ways to do this. One is through the traditional listed public instruments such as ETFs, mutual funds, and generally just listed corporate securities where insurance companies will dive in and take a look at evaluating investment board policies around diversity, environmental impact, responsible corporate policies. Some of them even go further and engage in what's called active ESG investing. And that's a little bit more indirect, but more recently we've seen insurers ramp up their investment efforts in private market investments. And that's through things like limited partnerships, joint ventures, private loans, and even direct investments in real estate or infrastructure projects, things like environmental projects like solar and wind facilities, carbon recapture technologies, battery storage, and even social projects like urban development, low-income housing, things like that.
What are some risk and performance management considerations for ESG investments?
Well, if you break it down into the public and the private assets, on the private asset side, there's a whole different set of documentation and data gathering that has to happen by the insurance company in order to properly value those assets and appraise them within the portfolio and ultimately report on them and score them. So for things like private investments through limited partnerships or even direct investments in real estate, you have to get timely appraisals, you have to look at the cash flows associated with those investments and match things like long-term and short-term assets and liabilities and cash flow streams. You've got to be able to process events. You know, a lot of those assets get transferred, they get rebuilt, and that information has to be tracked, as well as the metrics from an ESG perspective themselves. So what kind of clean power are they producing, or carbon offset is being created, so that information can be captured in investor reporting. Operationally, same type of challenges. Getting that data and information is often bespoke. Those deals are not, if they're not listed or publicly traded, that information can't just be pulled off of a data feed. So you have to have the expertise to be able to gather and process that information. And then in general, just managing risk across a portfolio of listed instruments and private instruments requires different inputs and factors to be able to look at and properly manage the risk of the portfolio in aggregate.
How is ESG investing impacting insurers' operations?
Operationally, I think it's, per my earlier comment, it's impacting them in the sense that there's a new set of reporting requirements. A lot of them have to provide scoring and methodologies to justify how they're kind of ranking these investments from an ESG perspective. For public assets, there are data services like Sustainalytics and other things out there that are doing some of that metrics-based benchmarking, so it makes it easier. But on the private side, they have to develop and explain the methodology. How often are they appraising the asset? What types of, whether it's carbon recapture or green bond information or geospatial data or things like that they're using in order to determine a ranking or scoring for those particular ESG investments. So it's a little bit different than your traditional listed equity or corporate bond investments and the reporting and processing requirements behind them.
What should companies be aware of when it comes to technology infrastructure and domain expertise when considering an ESG investment strategy?
Another great question. I think, technology-wise, you've got to have the right operational, accounting, trade processing, data capture facilities to be able to account for these different types of both private, direct and indirect investments, as well as the public investments. You have to have the infrastructure on the analytics side to incorporate additional data elements, third-party data elements like appraisals, like different sources of fees and expenses associated with these different types of green energy assets or social development assets. And then you need the business expertise, the acumen to understand what data you're looking at, are they being properly valued and evaluated and then reported on. So it's a combination of having the right technology to process the assets and report on them, and then the business acumen and expertise to understand the investments you're getting in and the information that you are reporting on. Within SS&C, we've been spending a lot of time on providing things like investor transparency reporting, carbon risk reporting, sensitive and green sector reporting, and also assistance with the regulatory reporting in particular for insurance companies, for example, SFDR or taxonomy regulation in Europe, preparation of principal adverse impact statements, things like that, as well as helping them account for and collect data to properly assess and value those assets within their middle office operations.
All right, Scott, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.